Welcome all to DeFi Crypto and Airdrops. I am Mike, aka Veteran Crypto, and this is Taylor and Jeff. Those of you that might have seen our usual Sunday show that we've discontinued to start doing this. It was Life, Liberty, and Liquidity, but we decided to move this to a Thursday afternoon and start talking about traditional finance, decentralized finance, wealth creation, wealth protection, tax mitigation, all those different things. So those of you that haven't met Taylor or Jeff, Taylor, I mean, if you want to go first and kind of introduce yourself to the audience.
I'm Taylor Willingham. I am basically an elder law estate planning probate attorney here in Texas. I own a tile company, and me and Jeff work on helping people with complex financial situations that they're dealing with, and we create all kind of interesting plans to protect people's assets and try to help them achieve the goals that they want to achieve in their lifetime. Financially, that's our whole planning. So we do crazy stuff all the time, different things, and that's basically me career-wise what I am.
Yes. Jeff, what is your background?
I'm good looking.
Well, we all know that. And we know you have an OnlyFans, for feet. So,
look, you got to have a diversified income stream in this economy. Dude.
Oh yeah.
That being said, I've been doing financial services, financial planning for 25 years. Yeah, 26 years this month. Been working with Taylor for about 15. I'm an independent RIA, which means I'm a fiduciary, and I can kind of do anything that's legal and ethical in the state of Texas or around the country, depending upon where my clients are. And I have some areas of expertise, primarily in alternative investments and in insurance and tax structures. So that's kind of what I do, and
awesome.
Interested in what this becomes.
Awesome, great. So, so pretty much what I wanted to kind of frame the conversation for today, for this hour, is I want to talk about, obviously decentralized finance. I want to talk about traditional finance. Every Thursday I want to just give updates on, because I personally see DeFi and TradFi merging at some point and just being finance. There's not going to be traditional finance and decentralized finance. It's just going to be finance, and it's just going to be, basically TradFi 2.0. So I want to talk about that. And I also want to talk about, I know that you both do these really good seminars where you basically counsel people on, creation of wealth, protection of wealth, tax mitigation, estate planning, all those things that the wealthy do to protect their assets and to mitigate their tax burden and things like that. So with that, I want to show our socials real quick. This is our X account, our official DeFi Crypto and Airdrops X account, _DCA. And you can follow me on my personal one on Veteran, the number 4 Crypto. And then this is our YouTube that you're probably watching on, DeFi Crypto and Airdrop. And that's it for that. But let's go through a couple quick points right now. So Discover Crypto is our brother channel. You can see over here, we have Discover Crypto, Blockchain Report, Blockchain Basement, and BitLab Academy. This is our network of channels. Jeff on Blockchain Report is my co-host on Mondays and Saturdays, and Discover Crypto is our parent channel. And then Blockchain Basement, Drew over there, he gives kind of the macro on crypto and just the news and what's going on. And then you got BitLab Academy for technical analysis, chart analysis, to kind of learn if you're into day trading, things like that. Really good guy, and he'll get you all schooled up on how to do that. But with that, just want to kind of go through. Oh, there's my setup here that I'm sitting at. We got my view out on the out in the woods.
Nice. It is a beautiful view.
Yes.
So highly recommend if Michael ever invites you to come up, go up and visit him. It's amazing.
Yes. Taylor's been up here, and so has Jeff. They hopefully enjoyed themselves.
That was
So,
great.
so Arrow has been pumping. A lot of people were worried. It went from $2.20 down to 30 cents, and a lot of people were worried, and rightfully so. If you're solely looking at price, when it comes to investments, both traditional and DeFi, you need to adopt an emotion-free investment strategy. And Taylor, Jeff, feel free to jump in, but for the most part, you want to invest in fundamentals. And if you're deciding to get in or out of an investment, it should be based off of facts, figures, data, fundamentals. Has those fundamentals changed? Me and Taylor were talking about Plume yesterday, and we were talking about how the CTO died. That kind of sparked off a sell-off of Plume. And I was telling him, he asked me if I was concerned about it. And I said, if it was 6 months ago or a year ago before they had a finished product, it probably would have. However, they were just ready to go live. And so they had a finished product. So it didn't affect my thesis for Plume. So with that, let's go ahead and start jumping into this. What are your guys' thoughts on the markets right now? TradFi or DeFi?
I can give my 10 predictions that I gave in my last presentation that I think are going to happen. Let me go over the 10 things. Okay. So these are my 10 predictions over the next 10 years. Number one, global debt will continue to fuel unprecedented inflation across the central banking system of the world. So inflation is going to be your biggest enemy that you have to be aware of. A lot of people don't understand this, but since 2020, you have lost 20% of your Social Security purchasing power. Yep. Because they do not keep Social Security up with actual inflation.
They don't do COLA adjustments, cost of living adjustments.
Well, they do it, but it's very low. Like it's not like they don't include. What are the two things they don't include? Fuel and
food.
Food.
Food and fuel, because no one needs either one of those.
When you're retired, yeah,
or never really.
Yeah.
Well, they don't want you to eat. They want you to die so that you don't take any Social Security anymore.
Yeah. So understand that you will have a Social Security. It will basically be worth nothing when you get to it. You can't rely on it. And that's really what's going to suck for most of our generation is that's how they're getting rid of it. They're going to inflate the currency and not adjust it to actual inflation. So that's my first prediction. That means for you that are investing in this world, holding cash is your worst enemy. If you're just going to hold cash, you're going to lose money. 7-10% a year guaranteed. If I told you, hey, I have an investment strategy for you, you're guaranteed to lose 7-10% every single year, but it will be consistent. I promise you. You'll never have this crazy 50% loss year, but you'll never have a gain year. You would get out of that investment. Look at the dollar as an investment if you're holding it. That's how you have to look at it.
And it's a terrible investment.
Right now, it's a really bad investment.
Yeah.
The United States and other major economies will transition to a central bank-backed digital currency. I think they're sold. They're going to try to get into this, which is going to be a major mistake when they do.
They just it passed the House. It was going to the Senate. I need to check. I think it passed the Senate, and Trump already said, "Send it to my desk without any pork, and I'll sign it." So,
you know what's interesting about that is it's just a quick little snippet before I let Taylor go on.
Oh, good.
Is cash might get real valuable if the governments of the world force us to use a digital ledger where every transaction is tracked.
Well, yeah. You know what? I want to say something about that real quick because I hear that a lot in crypto because most of the OGs in crypto, the reason they got involved with it is because it was decentralized and it was basically where they're off the grid with their money. We already kind of have that with the current system, with bank accounts. They know where you're spending your money. They can cut off your money. All the things that people are scared of with CBDCs, central bank digital currencies, they already do it. There's no difference. It's just real.
To some, especially at larger purchases. But I'm just saying, like there could be a world, if they wanted to, where they could say cashless society and cash becomes a gray market, black market thing, right? Yeah. And I'm just saying that's
bootlegging cash.
Yeah. Who knows, man?
No, people will just use. So I think the central banking backed digital currencies that they're going to do, of course there'll be the major crypto, but I think most people are going to stay. That there's going to be a lot more people that are just going to stay with Bitcoin and different things because they're going to be like, you know what, I don't want you tracking every little thing I do.
Yeah.
And so
at least not directly.
So I think initially what's going to happen when the government does come out, you're going to see a lot of money flood out of, different projects. But I think a lot of people over time that are now forced to use crypto where they weren't before are going to start looking at these different projects. And then it's really going to, some of these projects are going to become really popular to a whole different level. So it's going to get very volatile, in other words, once the government really starts moving that direction. But that being said, crypto is really the way that it's going to move for the future.
Well, and they kind of already are. I mean, it's, you're seeing it every day. JP Morgan's launching a stable coin. Treasuries like this that I just pulled up, this RWA.XYZ, this is real world asset tokenization. And you can see that, private credit is, a large majority of it, but they're tokenizing private credit. They're tokenizing the US Treasury debt, commodities, stocks, bonds. I know that I think it's Ondo. They submitted with the SEC to be able to tokenize stocks. Coinbase just announced that they're going to be offering natively on their platform. They're going to be offering DeFi. So the barrier to entry where, like Taylor, me and you using our Coinbase wallet to interact with these different protocols to do DeFi, that barrier to entry is going to be gone. You're going to be able to log on to Coinbase, buy stocks, sell stocks, buy bonds, sell bonds, whatever, enter into liquidity pools, all these different things that we do in DeFi that you have to, have a lot of knowledge to do. These barriers to entry are being taken away. And normies, the people out there that, maybe don't know how to do this stuff, that liquidity is just going to flood into this market.
You guys have names or normies. Normies out there.
Normies, dirty normies. It's like the muggles on the Harry Potter.
Yeah. Okay. Next, a decentralized digital currency will emerge as a global reserve currency, challenging traditional finance systems. I think the dollar is basically going to struggle to compete with some decentralized platform. I don't know what it's going to be. Right now it's Bitcoin. That is the main storage. Is it going to be in the future? I don't know. I can't guarantee that's going to be what it's going to be, but people are going to want to get away from a government being able to inflate the currency. Because it's a disaster right now. This idea, it really, I mean, you're witnessing the consequences of having money not attached to anything real when you watch things like this conflict with Iran. Like America just believes there's no consequences for how much money the government's going to spend. And they don't care.
They just keep printing money.
Yeah. And
they spend it.
Well, part of this, gentlemen, though, is because you get to a point where it's not real to people because they can't conceptualize it.
Yeah. Yeah. Because it's like we would do all the hookers and blow we possibly could, but our bank account eventually goes to zero. And then we go, okay, well, I guess I have to stop now, and be responsible with my life. But when you're the government, you can just murder people across the whole world with zero consequences and just keep borrowing until people say something about it. No one's ever
interestingly enough, the auction that they did recently for basically bonds, I guess it didn't go too well. You guys can probably speak more intelligently on it than I can. And I didn't the U.S. credit score get downgraded?
Yeah, but that's actually that's kind of a non-issue. It's not a non-issue. It's important, but it got downgraded by, I don't know, Mood, one of them, right? But they were the last agency to do it. The first time it happened was like 2011. So it wasn't like it would, because there's Moody's, there's Standard & Poor's, there's Dutch & Phelps, right? And so I need to look up who did it 2 months ago. But the first time it happened was 10 years ago, 12 years ago, with the other rating agencies. So it's a little bit like they're just kind of playing catch up. You know what I mean?
Gotcha.
But still, it's disturbing.
Okay, so the number 4 prediction I have. Within 5 years, approximately 30% of all white-collar jobs will be displaced due to automation and artificial intelligence, which is going to be a huge, huge hit to things. Jeff, I think you sent me yesterday, Microsoft's doing another layoff round of 8,000.
Actually, hold on. Jeff actually had on his screen, let me pull it up.
Well, I'm pulling up all kinds. Now I can share screens. It's a new day, gentlemen.
Yeah, no. Jeff was showing me this before we went live. This is the jobs or unemployment.
Right, so this is Challenger, which is the employment consulting firm, and they track layoffs, make projections and whatnot. And this is their unemployment tracker. And that gigantic spike is COVID. But you'll notice in 2025, we've actually had more layoffs than we did in 2008. Now, to be fair, we have more people than we did in 2008, right? It's not normalized for population, but that should be concerning, particularly because the layoffs tend to be, at least what I'm seeing more layoffs than normal in
like
higher
collar?
income, white collar.
Yeah.
Not that white collar are more important humans, but white collar are more important humans economically for the reason that they spend the money until you're ridiculously wealthy.
Oh, and taxes.
They spend all the money they make, right? If you're a household making $150,000 a year, right? You're taking your dogs to the groomer, you're going to restaurants, you're going to concerts, you're traveling, you go to, you're putting your kids in sports leagues and paying coaches, and you're remodeling your house. And those are the folks that are the engines of our economy, right? Whereas
not like Michael, where he's living off the grid in the middle of Washington,
building his own shelter. Well, look, I think it goes without saying, Michael's obviously a terrible American. I mean, he's not in debt.
Yeah, no, it goes without saying.
Doesn't spend a bunch of money.
Yeah.
Doesn't consume random entertainment. I don't even know how to talk to the man, actually.
He doesn't. He doesn't play the game. He won't go get a job and work 9 to 5 like the rest of us and be miserable.
Hey, you guys have probably heard this. We were talking about how big the numbers are when it comes to debt, deficit, what we spend. You probably heard this, but 1 million seconds ago was 11 days, 11.6 days. 1 billion seconds ago was 31 years ago. And 1 trillion seconds ago was 31,000 years ago.
Yeah.
And we have 34 trillion in debt, which, by the way, if you want to be really just on this, what is this, Juneteenth? If you want to get a little bit negative on Juneteenth, it's so much worse than that, because that's our technical balance sheet debt. That does not count future liabilities. So in other words, balance sheet debt is like, I have to pay.
So what you're
Johnny.
saying is it's worse than we actually thought.
It's like 70 trillion, because if you assume that we're not going to blow ourselves up in the Middle East and the rest of the world right now, if you assume we go on for another 50 years, you have 50 more years of guaranteed Social Security payments, guaranteed Medicare payments, guarantee Medicaid, and you start
Military
projecting
retirement.
average spends. Yeah, they don't have to put that's like. So I just want you to understand, like all the money that grandma's going to spend in a Medicare and Social Security for the next 30 years is not part of that $34 trillion figure because that's currently funded by our taxes.
Yes. So
and our debt that we issued that year to cover the fact that we have a shortfall.
Well, and that's an important distinction. So kind of to boil that down, basically what Jeff is saying is we have the 34 trillion that is what we're currently in debt for, but there's unfunded liabilities, which is future debt that's locked in, but it just hasn't been spent yet, which is what were you saying, 70 trillion roughly?
It depends on your present value analysis, but I've read it's anywhere from like 40 to 70 trillion. And honestly, that's a couple of years old. So with interest rates where they're at, it could be even higher, right?
So you're looking at a total of around $100 trillion in debt, both realized and unrealized.
What's the next like designation after trillion? Because we're going to have to learn that word. Quadrillion? Is that what it is?
A zillion? I don't know.
How many years into the past is quadrillion?
Yeah. So I want to ask you guys this. So with the jobs issue that Jeff has up on the screen right now, with the
quadrillion is the answer, by the way.
What's that?
Quadrillion is the answer.
Okay. So with the jobs issues, with the real estate issues, with inflation, with all these different things together, if you were to give somebody, one of your clients, advice on how to mitigate the risk and how to shelter themselves and shelter their wealth, what would be kind of the top one or two things that you would tell them?
Jeff, you want to go first? Sure.
Well, so I'm not going to spend the next 5 hours answering this question, though I could, but I will say this one caveat. It obviously depends on there's three major things it depends upon: age, wealth, and goals. That being said, if we assume because if you're 35 years old and you got a good job, then I'm saying, yeah, put it in the markets and be aggressive and so on and so forth. But for most of my retiree clients, particularly the mass affluent, right? So that's $500,000 to about 2 million. So they've got assets to put to work, but they don't have enough assets to make a significant mistake with. Currently, and I can actually show you a few things I've got pulled up, but currently I am very much using hedged products, things where you got principal guarantees, but you still get exposure to market growth. Nothing's perfect. There's no silver bullet, but you definitely want to be very concerned about where we are. So I'm going to share a different screen if I can.
Yeah, go ahead.
Look at this. So there's something. Now this is not a timing issue.
At the top, Jeff.
Yeah, I'm doing it right now. I think I just did it.
There you go.
So perfect. This is something called the Buffett Indicator. It's famous because Buffett created it, or just kind of came out. I think it was like 2001 in a Forbes interview. And it's a super, super broad, not a precise market timing metric at all, but it's a general idea to try to get a sense of how divorced are the markets, how divorced is the financialization of our economy from the underlying real economy. And all you do, this is what this is, you divide the total value of the stock market, see that, by the GDP.
Okay.
So what we say, so the total value, if you were to buy every single stock in the total stock market, what would it cost to buy that?
Yeah.
Divided by what was our GDP this year, which is the most broad measure of our economy's health and productivity.
And for those who don't know, GDP is gross domestic product. And what is that, Jeff?
Gross domestic, it's a accounting identity basically that measures
as simply
theoretically at the 100,000 foot level, captures the economic activity of all of us as consumers and businesses. How much are we producing? How much are we generating?
So the total value of everything that's produced in the U.S.
Correct. Gotcha. There's a formula for it, but So
yeah. We don't need to get too technical. I just for the audience, I just want to let them know.
Here's the main point. The Buffett Indicator right now is 200%. So currently, the stock market or the stock market is valued at 2 times what the entire economy is valued. Okay, but that doesn't really tell us a whole lot, because is that good, bad, or indifferent?
Yeah.
Now you come down to this chart. I assume you can see me scrolling.
Yeah.
I don't know if I can zoom in on that or not. But
If you hold your control button down and then roll your mouse your wheel, there you go.
look at that. All right, cool. So if you look at this, since 1950, now to be fair, I think we're in a completely different economic era, right? We're in the post-personal computer, post-digital age, right? We're an internet age. So to some degree, I start looking at this about the year 95, 2000. But if you look, this gray line in the middle is the historical trend line, okay? So from this trend line, this point would be 1 standard deviation above the norm. Where we are right now is 2 standard deviations above the norm. And to put this in perspective, that's where we were at the top of the tech bubble. And that's where we were right before COVID. And we're right back there. Now, could it keep going? Sure. Right? Maybe AI completely changes the game. But based on history, if I took off all the labels and I just said, hey guys, this is a chart of bananas to chimpanzees, and you had to bet which direction it's going to go, the chart would suggest it isn't going to keep going up.
Gotcha.
Right? Because historically, the average time is down here. As a matter of fact, another way to...
Well, and actually, real quick, scroll back up real quick. So those that watch any kind of technical analysis and stuff like that, you can see all along that top line, you can see that it's just bouncing off of it, almost like it's resistance. And every time it hits that, it bounces off. That's what he's talking about.
Sure, and same thing for look at this, the 1 standard deviation below. And here's, hindsight's 2020. I mean, I'll be honest, I was a financial planner. Well, I've been my whole life, right? But in 2009, right, people forget. So from January 1st of 2009 to March 9th of 2009, which is what, like 10 weeks, 11 weeks, the market fell 21%. Like every day it was just red. I mean, it was the only time I've ever felt like before is when I was, gambling in Vegas and I couldn't make the roulette wheel work, right? It was just like, wow. So obviously the idea of investing in March when it was just, when max unemployment, all kinds of stimulus, people feel like there's no end in sight. Well, that's obviously when you want to invest in hindsight. But look at this from a mathematical perspective. This is March of 2009, right? This hold on, if I can keep, it won't let me do it more than that. But that's March of 2009. It was just about 1 standard deviation below this 75-year trend line. And had you invested there, you would have had that whole ride up, which, by the way, is the best decade and a plus that we've ever had in the markets. But the markets are like a spring, right? So right now we're very expanded. If you go back and you look, it was super compressed and contracted. There's all this stored financial energy to go recapture all that value. So you have this massive...
a lot of stored liquidity, basically.
Right. So my point being is, to kind of finish the chart, if you look at this chart and you pick, obviously you want to invest when it's green, not when it's red.
You want to sell when it's red.
Right.
But what are you going to wait another 2 decades for that to happen?
What's that, Taylor?
Yeah, this is over decades, right? This is over decades.
But the problem is people right now are saying, well, I just sit on the sidelines and wait and wait.
No, and that's where I want to say, obviously there's things like matches and dollar cost averaging and all of those other things come into play. This is not the end all be all, but it's just to give people context. So when people are like, oh, I want to invest, I'm like, okay, I just need you to know you might be, kind of like when nobody could get a car halfway through COVID and people are paying $15,000 over MSRP. You knew that wasn't going to last, but it lasted long enough that a lot of people needed to buy cars.
Yeah,
the
but
other thing I was going to show you real quick.
Right now, you're basically saying, okay, if you're in your 70s, 80s, you need to be very careful.
You need to be hedged, absolutely, because you don't have because here's the deal: if you want something that if this goes up to here, you participate. But if it doesn't, you're not just tattooed when you don't have time. Because what people do not realize, and it's because we don't want to think about our mortality or things we can't control, everybody's most valuable asset is time. And here's why. It always goes the wrong direction, and you don't know how long you have, right? And all of this stuff takes time. That's why one of the biggest issues, probably the single biggest issue that is not properly done by most financial advisors now there's a lot of fantastic financial advisors, but most people, I cringe when I see any kind of long-term chart that a financial advisor has, and they'd be like, well, in the long run and on average, that's all great. But I dare, if you want to get punched, you go up to somebody that worked 40 years, busted their butt their whole life, saved, retired to do all this stuff, and retired in October of 2007, and tell them in March of 2009, don't worry about it because in the long run, it works out, right? Because in the short run, they lost half their money. And if that's the year you had to take money out because your wife needed surgery, or you had to repair your house because of a flood, or your kid got married, like when you take the money out at the bottom, that's when you lock in those losses because that money's no longer there to compound. And so that's the challenge of an environment like this. It's not that we are going to fall off a cliff tomorrow or that we don't make a lot of, a $30 trillion economy is amazing. But
and to put it in a term for the crypto audience, what he's talking about with the unrealized gains and losses and stuff like that is the same like in DeFi, where, if you're in a ranged pool and it goes out of range, you're basically hodling that asset. The only time that you actually lock in those losses is if you exit that liquidity pool. So, what he's saying is that if you own a stock and it goes down, as long as you're holding that stock, when it rebounds or goes back up, or if it does, then, you get those, that lost money back. But if you have to sell because of an emergency, you're later on in life and there's a medical emergency or something like that, then you're locking in those losses potentially, lower than your entry point. So,
and look, the pharaohs of old tried, right? They buried themselves with golden staffs and all kinds of stuff, but you can't take it with you. And at some point in time, 99.5% of Americans need to use what they've saved and invest to provide for their family and retirement and maybe immediate family members and loved ones. And so that's the challenge, right? It's not that if we all had 500-year time horizons like we're the endowment for Oxford, then none of these wiggles matter. And you just invest and you don't even worry about it, right? It's the fact that we're humans with one retirement, one life, where you got to start getting savvy, strategic, pay attention to risk. I'm going to pivot real quick. I got two more things I want to show you just to throw into the mix.
All right, real quick.
One, people are real pissed about mortgage rates. They want rates to come down, but this is since 1972. Guys, rates are barely back to the normal range. We may need to get used to these. Number two, my last thing I'm going to share is remember how the federal government started in May forcing people to pay back their student loans? That was a big news. I don't know if you paid attention to it or not. Big news, right? Some people are getting wage garnishments immediately.
Yeah.
This is why the number one asset of the United States government, a third of all their money is student loans. It's crazy. And by the way, look at this, gentlemen. Federal loans to students, 115 billion in 2017 to 1.5 trillion in
Holy shit.
15 years. Which, by the way, should piss everybody off because they have basically sold a dream to an entire generation that's just nonsense. Not that college isn't good or important or all that good stuff, but they gave 18-year-olds on average,
hundreds of thousands of dollars worth of loans.
$1.4 trillion in the last 15 years. And oh, by the way, who has the hardest time finding jobs right now? College graduates.
Yeah.
Yeah, it really is. Like when people say, "Oh, well, they borrowed it, they should have to go back." Yeah, but the government was engaged in what I would consider basically fraud
Predatory.
against.
Predatory lending.
and they charge an 8% interest rate. Like, you can go borrow money for SBA and go start a business cheaper than that.
They do. I mean, they didn't then, and people did have a chance to lock in really low rates, but it's not dischargeable in bankruptcy.
Yeah, it's slavery. It's literally slavery. You locked people in somehow. I do not know how in the world that you get past the idea that somebody who went to school to educate themselves can't ever get rid of the debt.
Well, and get this. I mean, think about it this way. Like, instead of the government being the intermediary, can you imagine if we just had some kind of, like, the super biggest crypto pool ever, and we said, hey, guys, we're all going to put in 1.5 trillion, and then we're going to give it to 20-year-olds and 22-year-olds and 24-year-olds without jobs.
Yeah.
Isn't that a good idea?
Yeah. No, that's like the worst fucking risk ever.
Well, let me explain why this is a problem for all of us, even if, like, I don't have student loan debt. No, I don't think any of us do. I
don't.
Good. None of us have student loan debts, but this is why it's a problem for every single one of us. First off, you have the baby boomers that are retiring. Okay. Now they have some money. They can spend it. They can put it back into the economy. But a lot of seniors right now need social programs to live. They're barely getting by. They really don't contribute to the economy that helps us in order for us to function. We now also have a rising generation of disabled kids.
Well, and not having kids.
Well, yeah, and people aren't having kids, but one out of every 31 kids born today is autistic. And many of those kids don't work. They can't work. They will never work. So you have this group of people in your nation that you all have to work together and do business with. And if you're going to take a significant portion of your working population and they have to pay money to the federal government, that money isn't going back into the economy and helping you. It's a form of tax that's happening.
Yeah.
And it's a huge tax that's happening. And what did they get in return for that taxation? Well, most of them are going and getting a degree in English or, theater. It's junk degrees. Like, they aren't actual degrees that actually are helping people. Of course, you have a small percentage that become doctors or accountants or somebody that actually has a degree that's worth it. But many of these people have worthless degrees. And so they are all being taxed. That money isn't going back out. It's going to the federal government. So who is really getting screwed over by that? It's us. All of us get screwed over because those people, they can't go out to eat, to, buy food at your business that you have. They can't contribute anything. They have to barely survive. And eventually at some point they just go, well, why try at all? Because I have so much debt. I'm done.
Yeah. Well, as you can see on this graph, since 1980, the green is college tuition. Average college tuition and fees have increased 1,200% since 1980. While inflation is 236%.
As soon as colleges figured out that the U.S. government was subsidizing these loans, they were just like, hell yeah, freaking some money.
If your target market has an unlimited rich Uncle Sam, why wouldn't you raise prices?
No, absolutely. All right, so let's jump to a new topic real quick. So
I haven't finished my list. No, it's good.
Oh, go ahead.
Your list.
Go to your list.
Okay. Global energy output will increase tenfold over the next decade, driven by advances in renewable and fusion-based technologies. We need energy for two main reasons: robotics and AI. You need about 10 times the amount of energy that we currently do. So, investment opportunity for you out there. Precious metals like gold and silver will remain reliable sources of value and play a strategic role in wealth preservation. Because they're inflating the dollar, gold and silver are still good ways to invest. And then the other ones aren't really applicable. But what I want to get to is I want to use an example like right now of why DeFi, I like it as a great way to invest right now because it's producing such significant returns that even when you have big drawdowns in your DeFi portfolio, if you can consistently make good income off of them daily, like you are, it isn't that big of a hit. Like like Plume, like me and Mike are invested, and of course it got hit. How much did it come down? Like almost 60, 50%?
Yes, it was about 50%.
So I've been invested in Plume for 2.5 months.
Yeah, about.
Even though in that time I took almost a 50% hit, I'm up because of how much income it produces. So I mean that it is an amazing investment. Like yesterday, I have about 30 grand in Plume. Yesterday, I made $2,000 in income.
Well, right now, I have it up on the screen. I'm making 630%
It says it's
on
offline. What you put up on screen
says offline.
is that what it says on yours, Jeff? It says offline on me.
No, I don't
Oh, I
see
can see
it.
it. There it is. Now I see it.
All right. So yeah, I mean it's like DeFi is a great hedge against inflation. I mean it's worked great for me. I mean I've started out with 15 grand back in October, November, and I'm about 31,000 now. Even with the market dumping. So and that's all a certain amount of tokens. And when the market rebounds, who knows what it's going to become. If we just go back to the kind of the recent highs that we saw back in December, January, I'm looking at about $80,000-$90,000 that I've made off of 15,000. So
I'm going to put this out there. So yesterday I was calling Mike because I was a little like, well, somebody online had posted that Plume CTO didn't really die, that there was a fake. And it got me a little concerned because I was like, is this just a pump and up? Well, Michael took me to actually Plume's site and we actually went through things. And I could tell you right now, their platform is amazing. It is really awesome. That's why I put a bunch of more money into Plume yesterday. I was really shocked at how well that ecosystem, what they've built out over there and what it could possibly be in the near future here. There's not a lot of times that you get blessed with an opportunity to maybe invest in something that really could take off. I'm not saying Plume will take off. I'm not saying that it will become this amazing thing in the future. If what they have built already is actually put all together, I think it's going to be absolutely fantastic. But it would not shock me.
RWAs in general, it's an opportunity.
Yeah, I would not be shocked at all if a year from now it's at $1 a coin and 10x'd itself. So an opportunity that's out there for people that may, might want to take a little risk on something and actually make some money. If investing, it always needs to be comfortable for you, you'll never be rich.
No, and that's I actually did episode 8 of my DeFi Academy. I actually just did it the other day on Tuesday. That's what I talked about, is basically building out a DeFi portfolio, and what the questions you need to ask yourself. And like Jeff said earlier, is what is your risk tolerance? What are your financial goals? And a lot of that is based off your age and your income and a lot of different factors. But I basically went through and talked about how you need to build out the foundation of a DeFi portfolio to where you are where you're in lending, full range pools, things like that, to where it doesn't matter. You're not going to go out of range. You're going to mitigate the impermanent loss, things like that, to where you earn a good steady yield. And then you take that free money or that free yield and to open up new positions that are maybe, a medium risk or high risk. Then you're not touching your principal investment, and you're kind of protecting yourself from losing that initial investment. Of course nothing's 100%, but that's just a really conservative way to build out a portfolio. Whereas if you go all in on a meme coin, chances are you're going to lose all your money. And there's nothing wrong with that. If you're a young 18-year-old kid and you're spending a couple $100 to go in on a meme coin, and that's every dime that you have time in your life to recoup those losses. Whereas if you're my age, 51, and you're retired and you're looking to make residual income, you're going to want to err more on the side of, low risk, because you're just trying to earn residual income. You're not trying to, make a one big hit. You're just trying to slowly grow your portfolio. And it just really depends on what you're trying to do. But what I got pulled up on the screen is what Taylor was talking about. It's the Plume portal. And if you haven't checked it out, again, not saying invest in Plume. I never tell people what to invest in. But it's a great platform, and it's put together really well. So you can come here and it tells you, all the different DEXs or decentralized exchanges, and all of this is RWAs. So like these nest vaults, they're all tokenized treasuries. Like this one here, flagship yield strategy, safe yield, liquid yields with diversified institutional grade assets from AAA firms backed by robust liquidity. And it's made up of, Blackstone, which is part of BlackRock, Open Trade, Credible, Casu, Superstate. You can come over here to the ecosystem, and you can see there's over 200 plus dApps, basically being built out on Plume. And this is all backed by major institutions, like Ondo is one of their partners. But let's see, you got Apollo, Galaxy. I mean, it just, the list goes on. There's endless, institutions that are dumping money into and not just Plume, RWAs in general. They see what is happening with DeFi and the opportunities that there are for them and us to make liquid. And, me and Taylor are talking about this right now. And Taylor, let me know if it's okay to talk about this, but the, that fund that we're going to be meeting about, is that something you can talk about?
Jeff, you want to talk about the fund?
We can talk about it in generic terms.
Yes, in generic terms.
So we are examining the opportunity of just one. Sorry, someone's working on ripping stuff up. We're doing filing things, and I wanted to make sure you could hear me. So generically speaking, we are looking at a litigation finance fund crypto solution where people can buy into crypto on the Plume network, I believe, and they will have exposure to litigation finance as an asset class, which is a phenomenal, uncorrelated to, tremendous historical asset from a lot of perspectives, and we can get into that later. But the idea is, the one challenge about litigation finance, which is where you back litigation and you get a share of the proceeds, the judgment, presuming you win, is it's illiquid until you get to the judgment. So the idea is a portfolio of cases to give you diversification and robust return potential, but yet on a network where you then have the liquidity that the crypto provides and DeFi provides. So it's an interesting idea. It's something we're just now starting to investigate, but it's something we have relationship with institutional partners that do this really well, and we're looking forward to seeing what comes up.
Absolutely. So basically what he's saying, just to boil it down, is they have a fund, and what they do is they have what usually smaller law firms or even bigger law firms, whenever they go against, like, I'm just gonna use this as an example, like Pfizer, because of the shot and stuff like that, there was a class action lawsuit. Most of the time, these are settled out of court because these massive companies have an army of lawyers on a retainer that they'll just kill you with cost, to where you cannot win, and they know that, so they're just going to say, okay, well, we'll give you a settlement, and off you go. So what this fund does is it would allow those of us, like myself and all of you out there listening, to where they would tokenize this fund to where you could, buy in with, $50, $100, $1,000, $1 million. And what it would be is a long-term investment. And like Jeff was saying, is they have a portfolio of cases to where, yeah, they might lose one or two, but then when they win one, because they have the financial backing to where they can put in the years or months or whatever that it takes to win these, then you would get a yield or a return on your investment. And you could opt to, take some profits or roll it back in to the fund and rinse and repeat. So it's just one of the ways that tokenization of real world assets is just going to open up a floodgate of opportunities for me and you out there. Did I capture it?
That was a fantastic summary.
Okay.
I don't know if my screen shared. If you
Yeah,
share
I'll
it real quick, I want to show you something. This was a study done. Now it's over only a 2-year period of time, but it's over about 200,000 cases. These are the internal rates of return as an asset class. And just so you know, this is public information. This is not anything I'm directly involved in by any means, but this is from Morningstar data. So it's not like I can even show you where we're getting it from, right here in this. This is portfolio management research. It's a whole report. It's public information source, Mornings investments data, right? There we go. Internal rate of return overall for mass torts, about 20% a year. Personal injuries, about 38%. Commercial claims are about 40%. Now, what's interesting is that's for the winners, right? So the winning ones, the dollars you put towards a winning case, you're compounding your dollars, between 20 to 40% a year. But you have to balance that out. You're not going to always have winners, right? So due diligence is huge. Expertise with trial attorneys and people in those is huge. There's a whole lot of things that goes into the sauce, but it's an interesting asset class. But here's the thing I love about it most. It's uncorrelated to everything, right? Interest rates, oil, political parties, none of it matters. Well, I guess could if they change what limits are in lawsuits, but none of it matters because as long as humans are humans, until the world ends or Jesus comes back or whatever might happen, aliens land, we're going to sue one another. Matter of fact, America has 94% of the world's attorneys, and we have 4.5% of the world's population. They're going to eat, right? So it's a very interesting asset class. But one of the things that I think is most interesting about it is it helps level the playing field between the Davids and the Goliaths, right? It gives people resources, assuming they have a quality case. The number one thing I hear when I talk to people about is why I don't like frivolous lawsuits. We don't either. But you know what happens to frivolous lawsuits? They get thrown out or they get settled for tiny pennies on the dollar. If you want to know what a non-frivolous lawsuit is, find a lawsuit that's backed by litigation finance. And that means somebody with very deep pockets with an army of attorneys took a very serious look at it. So it's an interesting idea, to say the least.
Absolutely. No, like I said, it's just a perfect example of, of just the diversity of investments that are going to be out there and available to, people like me and, people that aren't accredited investors potentially. It depends on what the, regulation, that gets, signed into law and, or, bills that get signed into law and regulation that gets drafted and things like that. But, the great thing about blockchain technology is just the ability to make illiquid things liquid, real estate, art, stocks, bonds, treasuries, gold, silver, all the commodities, oil, all these different things that usually you have to go through humans. You have those, those friction points of you can only do it 9 to 5. You can only do it Monday through Friday, no holidays. If you want to make your investment liquid, you have to put in a sell order, and then it takes days or weeks or whatever it takes to for your broker to sell that, and then get the money into your account, and all these different things. With RWAs, DeFi, with blockchain technology, it's going to be a couple of clicks, and that and you're liquid again. So this is what I'm excited about. And, and that's why I'm here and why I'm learning about DeFi and learning about RWAs, because early adopters are the ones that make money. early adopters of Microsoft, of Amazon, of Google, back in the day, Kodak. If you're able to see an emerging technology for what it is, and and all the naysayers that you see on social media and stuff talking about crypto's a scam and all these different things, it's like, yeah, there's scams in everything. I see meme coins as potentially scams. If you go into anything without education of how it works, you're going to get scammed. Traditional finance or decentralized finance, it doesn't matter. But if you're able to see the writing on the wall with emerging technologies, and you position yourself correctly based on fundamentals, based on facts, figures, logic, and not emotion, you potentially are setting yourself up for life-changing money. And part of that is education. So Taylor and Jeff, I'll put some links. I know I'm kind of pushing you guys. I'm wanting Jeff to learn more about DeFi, and I definitely want to figure out a way to put some of your guys' seminars online for people, or give them some sort of access to those. But we can talk about that offline. But those of you out there listening, I'll say this in closing and then let Jeff and Taylor give their closing thoughts. But educate yourself, position yourself. No matter how much money you have to start with. On our channel, we teach how to do airdrops, which is free money. You can do DeFi with very low risk to where you can just make slow, steady returns of 20, 30, 40, 50% APR, and which is stellar return. But educate yourself, position yourself to change your life financially, because the government's not going to do it for you. Like Jeff was showing earlier, joblessness is going up, inflation's going up, the cost of living is going up. It's getting harder to buy a house. Interest rates are up. Gas is getting more expensive. Everything, life is not getting easier. You need to take control of your own life and put more effort into positioning yourself to be comfortable. So I'll end with that. I'm starting to ramble, but Jeff, closing thoughts.
Well, I mean, I agree with everything you said, and I'm excited about this platform, and I think this is going to be a good show, and I think we'll cover a lot of things. I do think, now more than ever, people need to be, like you said, they need to be as educated and as fight ignorance or assumption as much as possible. I mean, I don't know if anybody had on their bingo card that 7 days ago Israel was just going to start bombing the crap out of Iran and what right. So there's always something, right? But and to some degree there always has been something. So there is actually a chart out there that says this shows like the number one reason not to invest in a given year, right? It's the Kennedy assassination, or it's the Nixon impeachment, or it's the the oil embargo, or it's on and on and on and on and on. So there's always something. So it's kind of nice to know we're resilient. We've always persevered. But I do think we are getting into a more and more complex society. And the one kind of warning I have for people is I do think that whenever the next recession hits, it's really going to hit, I think, office workers, white collar jobs in a way we haven't seen in a long time. So yeah. I'll close with that.
All right. Taylor?
I think the biggest thing that you could just take from everything is changing. And that is the greatest opportunities to really make a difference for your life. The status quo stays the same, you're going to be stuck. But if you want to take advantage of stuff, you got to put yourself out there and learn and take risks. Just understand that there's going to be no guarantees in anything. Just go out there and just go, you know what? I believe in something and I'm willing to go down with this ship because I really believe in it. Look at something that actually provides value. That's the big thing, and be someone who actually provides value in the new world. And it's going to benefit you greatly. But if you're going to just be the same old you and not change and not do things differently, you're just going to go off the ledge with everybody else.
Yeah. If you want what everyone else has, do what everyone else is doing.
Yeah.
That's fair. That's why I have a dad bod. Speaking of, my lunch is here, and so is my 1 o'clock appointment, and it's 5 minutes past, so I got to jump, gentlemen.
All right.
Okay,
So, yeah, you guys can go ahead and jump. I'll just do a quick shout out.
Okay.
I appreciate you both. We'll see you next Thursday.
But next time, guys.
Yeah. So I'll say this: if you're interested in learning DeFi and in how to change your financial future with guests like Taylor and Jeff, please give us a follow, like and share, and join us and figure out with us a way to where join our Discord. We have a great community in there, and everyone's more than happy to help. Everyone in there is making money, and yeah. And until next time, Veteran Crypto out.